Hey everyone, welcome to Leading Indicator, a show by Public.com, an investment show bringing you insights from some of the sharpest minds in the worlds of business, finance, and technology. And by the way, Public just launched options trading. If you activate your account between now and March 31st, you can lock in a lifetime rebate of 18 cents per contract traded. No commissions, no per contract fees, anything like that. And that makes Public the most cost-effective way to trade options. Enable options trading over at Public.com by the 31st of March and start earning 18 cents per contract traded. With us today to talk all about options and volatility trading within the market is Brent Kochuba, founder of SpotGamma. Brent, appreciate you being here. Thanks a lot for taking the time.
Thanks very much for having me. I'm excited to talk everything options today.
Let's start with obviously where I think the topic of conversation has understandably been for quite some time. NVIDIA, which is up 300%. I can't believe that's a real thing, but it is up 300% or so in the past year. Recently became the third most valuable company globally. Market cap at this point well north of $2 trillion. The AI hype continues to boost. Brent, what has options activity looked like within key artificial intelligence names like NVIDIA?
Yeah, it's the leading sector. You know, the kind of rolling joke is that it used to be the Mag 7 that was driving the market, and now it's just the chip sector. If you look at not only NVIDIA, but you have SMCI, which is getting added to the S&P 500 now. You have Avgo, which is, I think, a top 10 name in the S&P in terms of market cap. Obviously, AMD. And so what we see is those names are driving markets higher, and it's about, that sector is about 8% now of total U.S. options volume. And that has really just gone crazy this past year, really. So those names are driving everything. And the current stance of the market is that we had extremely bullish call action into really last week. That call action kind of cooled off a big deal on Friday. If you remember Friday, there was a humongous intraday reversal in the markets. And I think we're digesting a lot of gains into a big options expiration, and that's across the chip sector, really. And that immediately flips over to this NVIDIA event that starts on the 18th, where they're going to offer, their new products or just kind of talk about what they see going forward. And if you look at the implied volatilities related to that event, you can see that the market does care. It is pricing in some movement and volatility around that. So if you're in the chip sector, this Monday, Tuesday kind of period where they're announcing new products and things like that is the next trigger point for, if we're going to move higher or kind of a continued consolidation.
Is there a story, I wonder, that the options trades are telling us? And is that story largely at this point just a wait and see for what happens with these announcements on the 18th?
Yeah, it's a great question. So if you look at things like skew, implied volatility and skew metrics and things like that, what you could see was that there was an extreme bullish position, which is not much of a secret. It's not that shocking, obviously, when I tell you that. So there's really extreme bullish position going into, again, last week. And I think what happens in those situations is that calls get so expensive that it's hard to justify owning them still, right? Because in order for you to get a payoff on those calls, you need just ever increasing moves, right? So, if you bought, let's say, a 1 week call in NVIDIA last week, you needed a 10% move, right, to get that call to pay off. It's just a rough example. And so what happens is that the move sort of stalls out, right? Where you just hit this convexity where the stocks go up so much, so fast, and things need a period to cool off and consolidate. And I think that's kind of like a blow off top, for example. And I think that's the period we're hitting. So if you look at term structure, which shows us the implied volatility over time for a name like NVIDIA or even the sector like SMH, you'll see that there is indeed higher implied volatilities tied to this NVIDIA event coming up. And I think what that really means is like, hey, if they launch some kind of generative AI tool that everyone thinks is going to add another, whatever, $30 billion a month to NVIDIA revenue, then the sky's the limit, right? We're just going to keep going up again. And of course, that runs into these macro events like VIX expiration next week, as well as the FOMC on the 20th. So both VIX expiration and FOMC are on the 20th. So there's a cadre of kind of trigger points, we like to say, over the next couple of days.
Yeah, I'm glad you mentioned the other event on the 20th. Obviously, it's all eyes on Chairman Powell, even if we already kind of know how that meeting's going to go. But it's worth noting that expirations is worth keeping an eye on as well, especially for market reaction into the close on that afternoon. Let me ask you about overall market optimism. The Dow, the S&P, the NASDAQ, you name the index, it's up. It has surpassed its 2021 highs, continued to push higher. Even Bitcoin rising to 72,000 just a few days ago. Does the market optimism have legs to stand on?
I think
and if not, is there a bubble concern? No, go for it.
Yeah, 100%. Didn't mean to cut you off there. I apologize for that. Two things on Bitcoin and even on gold. If you look at the forward S&P returns based on what's been happening in gold and Bitcoin, the forward S&P returns are very positive, and they're consistently positive. And so what that tells me is that those two sectors or assets going up are long-term bullish in the market. And I think when you look at this year, just in terms of the CPI printed yesterday wasn't hot enough to really cause any angst. Implied volatility just sank after that, which is another kind of forward vision or view into risk. And so the takeaway here is that this seems a lot like 2021, where little individual dips were bought, right? And we just continue to rally and rally and rally all year. And when you look forward in this year, it seems like the only maybe bump stop in the road is going to be the election, right? And it's just going to be kind of status quo from that perspective. And that seems to be what we're seeing in a lot of the data. Now, I want to turn to a couple points. If you have looked around a little bit in markets, there's some metrics on what we call correlation. Correlation measures, let's say inside of like the S&P 500 index, how unified moves are. So are all stocks going up or all stocks going down? What's happening? And what you see is that correlation right now is very low. And so that tells us it's as low as it's been since 2019. So that tells us that obviously there's very poor market breadth here. That's a measurement of market breadth. And it's just the semi stocks and chip stocks that are really reading the rally. The second part, which is very interesting, that is this idea of dispersion. So dispersion tells us inside of the index, how much are the individual stocks moving? So are certain components moving a lot relative to other components? And right now we see very, very high readings of dispersion. So what does that mean? That means that NVIDIA and these other chip stocks are moving so fast that they're now greatly outpacing the rest of the other names, let's say in the S&P 500 index. Now, typically you only see high dispersion readings when the markets crash. So for example, March of 2020, when the world shut down because of COVID, all stocks went down, right? Every single stock went down, but some names like cruise lines went to zero, energy went negative, everything went up, but some stuff really felt the pain a lot more than other stocks. So that was a high dispersion environment as well. So what's happening now is we see dispersion sort of flipped on its head because certain stocks are almost crashing up. And the reason that this is important is because if you look at historical times that sync with this, you could see similar movement in 2021, which, felt a lot like a bubble in a lot of ways, particularly in August of 2021. And then you can go back to the tech bubble in 1999 and 2000, where you see very similar stuff. Remember, like pets.com and names like that were really going crazy, and the rest of the market was hanging in there, but left in the dust, right? And so those are signs that the market is entering a bubble phase. However, this is the caveat, the bubble can last for a while. And so there's not signs right now that things are going to break. I think you need a macro trigger, like an unexpected, rate hike, or I don't think we're going to get any of that right now. But I just think it's going to continue to be this status quo now until that election period. So takeaway is a lot of signs we're in a bubble, but bubbles can grow bigger.
Yeah, I mean, do you think, let's stick with the S&P 500, that dispersion, is it being driven specifically by some of these really consolidated names, by the AI companies, by the NVIDIAs or other growth names?
Yeah, it's
and talk and more about that correlation. Yeah,
absolutely. It's the chip sector. And if you look at, for example, the Mag 7, a lot of those names aren't doing very well at all, right? Tesla is at major kind of recent lows. Apple fell very sharply recently. Google's off of its highs. Microsoft is not really, making new highs. Amazon's doing okay. Meta's the only real Mag 7 name that is kind of forging new highs at this moment. So there's one or two ways you can look at this. You could say, okay, those leaders, the largest, most important companies in the U.S. stock market are stalled out a little bit here. Or you can say, hey, those things are going to join the party next week. I think both are viable options here to look at. And I think so much of it depends on, hey, we get through NVIDIA event next week. If they have some really exciting products and Powell just delivers like a dovish kind of nothing done, then that market just launches and then maybe some of those other names start to catch up. But it is clearly just chip sectors right now, and I don't think that's particularly healthy. The other thing I would note is, we have SMCI joining the S&P 500 now on Friday. That's a name that's had a lot of volatility. I think that volatility comes in a little bit, and I think some of the bullishness in the chip sector just continues to kind of wane because it's gotten they've gotten over their skis on a lot of metrics. So
sure. So let me ask you a bit more about the dispersion thing. Now, if an investor were to pull up and look at how the 11 sectors of the S&P 500 have performed so far year to date, overall index up 8.5%. But I would argue you got some of these. Some people might call it a broadening now. You look at some cyclical sectors that historically may underperform. While the S&P is up 8.5, financials is up almost 8.7. That's outpacing the broader market. Healthcare is not far behind at 7.8. Industrials, XLI is at 7.2, and materials is at 5.6. So how do you sort of look at what some people might say, hey, maybe there is a bit of a cyclical broadening out versus the points that you were just making with regards to dispersion? How should an average investor kind of marry those pieces of information together to become more informed as we move forward in 2024?
Yeah, so the way that I think about the market right now is that we have this trend higher. And inside of that trend higher, we can sort of, almost like an RSI, I think a lot of people are familiar with that, or overbought, oversold indicator, right? And yes, you're 100% right. Like financials are doing great. Industrials are doing great. They're at all-time highs. The S&P is at an all-time high as well. However, the chip sector itself is, orders of magnitude over that, right? And that's really what it is that those leading groups have gotten so much farther ahead. And so you can make a great argument that the rest of the group is likely to catch up on a relative basis. And I think that's, what we're talking about here. And to that point, if you have a broadening out of the rally, I think that's really quite healthy. And again, when you look at Bitcoin moving up, I think that's a risk sentiment indicator, right? If Bitcoin's going up, people want risk. The other factor that's involved in this market, which is a little tricky, is we have a lot of systematic call overwriting now, these structured products. So if you look at stuff like a JEPI, which is one of the biggest ETFs now in the world, they sell calls consistently as part of their ETF prospectus, right? They sell these monthly S&P 500 calls. There's a volatility dampening effect that supports the broad market as we go up. So there's a lot of financialization occurring right now. New ETFs are being launched daily that sell options, for example. There's an NVIDIA 2x long ETF. The only thing they do is they are double long the single stock NVIDIA. There's also a 1.5 long NVIDIA ETF because, 2.5 is not enough. So there's this financialization aspect that adds a lot of leverage to the market. So back to this point of the long-term trend going up, things can get very overheated. Like NVIDIA's up, whatever it is this year, 40, 50%, it can drop 5%, which will hurt in the short term and then just pick up and kind of continue. So I think it's this reversion to the mean in certain sectors, and it could be meaningful because you could be up 10% this week, but then back down 5, 6, 7% next week. The trend is still higher, but things can get overheated very quickly in this environment because of all that leverage.
Yeah, people like to say the trend is the friend, and you're right. We saw that with NVIDIA just a week ago, right? We had a 4% pop one day, a 4% pullback the next day. Still somehow, because you talk about relative strength index, the RSI currently is only 67 for NVIDIA. I say only because we look at that 30 to 70 range for overbought versus oversold. Yeah. I mean, obviously, when you take in forward-looking PE multiples for a company like NVIDIA, people say, well, it's actually relatively cheap to where it's been historically, given where we think it's going to go. So I appreciate that you mentioned RSI. We talk a lot about it here with our users at Public, and I think that's always a good thing to kind of keep in mind. So I had asked you a little bit before, or I mentioned this idea of a bubble. Are there any bubbles to any of this? It could be gold, it could be Bitcoin, it could be any of these AI stocks, anything that has you concerned that you're watching, Brent, that might be to the advantage of our listeners to pay attention to as well.
Absolutely. I mean, my view on the market is, you look at crypto and there's a lot of things happening that you could easily say, hey, look, there's new ETFs, there's new markets, there's monetary policy that may be, or fiscal policy that are driving some of these things. You look at NVIDIA, for example, people can justify some of these forward PEs right now based on some new products. And is AI going to take over? So, all of those things are things that are outside of my purview because I really just focus on the options market. And the thing that I see that concerns me is the leverage component. So much volume right now is 0 DTE or focused on options that expire in a couple of days. And I think those are excellent trading tools, but the volume's really gotten concentrated into that shorter time frame. And things like the NVIDIA ETF, that 2x leverage ETF, that ETF has $2 billion in management and assets in management in that ETF. So what happens is you get these moves, and you brought up NVIDIA last week. NVIDIA had this unbelievable move up to 980-ish on Friday. And our options indicators saw $4 billion worth of NVIDIA calls come for sale as the stock approached 980, and the stock came down nearly 10% really from that high. So these really violent moves are symptomatic of a lot of the ways that things are being traded right now. And I think that you can exploit that as a trader if you understand the environment you're in. So you got to be, it shortens everyone's time frames to kind of be more quick getting in and out of a lot of these positions, particularly for trading options, because you have a fixed time frame on your call or put, right? They expire. It's a little different if you own the stock and say, who cares if it gets overbought in the short term, because I think a year from now it'll be whatever, double. So that leverage is a concern. 50% of S&P volume roughly now is 0DT options trading, but there's also a big increase in the single stock stuff that trades on, every Friday. And so, that flow is significant, and it's increasing. It's at 2021 levels, which to me is it's a lot of speculative activity that's happening. And so the takeaway from that is that, volatility can't really be like just destroyed. It gets like transmuted. So what do I mean by that? It means that if we crash up, if we have these incredible rallies up, that volatility has got to also come back down, right? You can't just have the situation where we go up 50, 60, 70% in a day and then just pin there. It's kind of unlikely. And so that's my view for these chip stocks that get overbought, and even crypto, right? Bitcoin, look, it's doing great, but its rate of change is explosive, and there's going to be a correction, right? Who knows where it starts to correct? And that correction is going to be pretty violent and shake a lot of, short people out. And so you have to be aware of those. If you're a short-term trader, you have to be aware of those moments.
I appreciate it. And there's so much to watch for a stock like NVIDIA, including a potential stock split at some point. I mean, we've watched that 980 level. If and when it breaches 1,000, what does that do for its addition to other indexes? There's always Dow whispers for a company like NVIDIA, but obviously you need to pull that surging stock price down. So there are lots of fascinating storylines there to watch. Let me ask you about the VIX a little bit. We've been doing several interviews this week about the volatility index, still hovering around 14. I've made the point before that, if you just look at the VIX, any one number doesn't tell you the story. It's always relative to its history, where it traded in COVID, where it traded this time last year, a much bigger picture. But what usually influences the VIX to move as you see it, Brent?
It's a great question. I want to add one quick point on the stock split stuff. If you remember 2021, there was a major high in August of 2021 when both Apple and Tesla split. And that happened right at the end of August, and that marked a real short-term high. There's some things are splitting now, like the NVIDIA double levered ETF, the SOX ETF is splitting. So that could be a real signal. I just wanted to mention that. Back to your question on the VIX. The VIX has had some unbelievable jumps related to VIX expiration when it comes up on the 20th. If you remember in the February expiration, the VIX went from 14 up to about 18 and a half in a single day, and then it got sold violently lower after that. And so we have that period coming up next week where there's a lot of VIX positions that are set to roll and adjust. And I think that is in play again here. Now, the VIX is tied to 30-day implied volatility of the S&P 500. So it's a little bit of a longer dated gauge of market risk. Right now the VIX is around 13 to 14 in that neighborhood. Based on how much intraday volatility we have in the S&P 500, in other words, how much is the S&P moving, the VIX is fairly valued at 13 to 14, I would say. The situation is going to be when we get a longer term signal of risk, meaning if you think about last year, we had the bank failures, right? So let me pause for a sec. The argument is that you could use 0DT options to hedge out, say, the CPI number or the FOMC data or whatever it is. But when you have known unknowns, like when banks were failing, you didn't know when a bank would fail or if it could fail, but it seemed like there was higher odds or likelihood of that situation happening. That's when you want to start to own VIX options, VIX calls, because that's more reactive to systemic issues, right? Stuff that you can't just hedge out with a single day option. And so when the VIX starts to rise, that's a signal that the market is sniffing longer term risk. So the takeaway here is that we have a big VIX roll coming up next week. That could cause some short term market volatility. But what you really want to see is that volatility holding in a more sustained manner as a signal that the market's starting to sniff out some problems. The other thing I would note on that is if you're looking to hedge your portfolio, I think VIX calls now are the way to go. And that's because if the market does jump up higher, it holds the VIX index up, right? Because volatility exists if the market goes up or down. So if the market rips up 3 or 4% here, VIX is likely to hold at 13 or 14 as a function of that volatility, right? So if you own VIX calls and the market crashes from that higher reference point, then those VIX calls are a great hedge. If you were to say buy an S&P put here, like let's say I bought the 5,000 or 500 spider put, for example, and the market rallies 3%, well, that 500 strike put is so far out of the money now, I can't hedge my portfolio anymore, right? So I think that's an interesting way to think about it as portfolio values accrue, people are making money, they're getting a little nervous. You can really look at that VIX index as a pretty good hedge, I think, in these types of environments.
Finally, Brent, any catalyst that could break up the ongoing market hype, cause a potential bubble to pop? Anything that you're watching for that our listeners should also be paying attention to in terms of the never-ending world of what ifs and things that could happen?
Yeah, I mean, the NVIDIA event is a big deal next week. I think if they just offer something that doesn't spark all that much excitement, then I think that really zaps the energy of the chip sector broadly. And it'll take a little while for that to recover. If Powell comes across as a little more hawkish than people expect, I mean, people have very low expectations right now, then that's going to be the real kind of risk trigger here as people have to adjust to those rate expectations going forward for the end of the year. And I think they're pricing in a June cut right now. The CPI was a little hot. There's a PPI reading tomorrow. So this is a chippy period in here where you can see a lot of things change. Our risk off measure is 5,100 in the SPX. If we move below that, then I think we immediately kind of pop immediately down to 5,000. 5,000 in the SPX is a very big level. There's a ton of options positions there, so that should be a pretty good support area. If we lose 5,000 in the S&P, then from an options hedging flow perspective, that's where we could have that's the bubble's over kind of red flag to me. So I would expect a little consolidation here over this week. Powell probably comes in line, and then if we go over 5,200 in the SPX, that's the sign that the bubble's going to expand.
Absolutely. My man, that was an awesome conversation. Really grateful for the context. I could do this with you all day. We got to leave it there. That's Brent Kochuba, founder of SpotGamma. Awesome perspective. Thanks a lot for being here, Brent. Appreciate it.
Thanks so much.